Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Insight. In this video, we'll discuss the post-election market rally and what it means for long-term investors. With stock market valuations above historical averages, investors will benefit from these returns, but should remain disciplined and focused on their long-term goals. The backdrop is that economic fundamentals are still strong. We're seeing steady corporate earnings and solid GDP growth. The Fed's recent rate cut and continued low unemployment levels also help to support a balanced outlook. So, what do investors need to know about the current market environment? First, this chart shows stock market valuations today, 1 year ago, and the range of standard deviations above or below the mean since 2003. As you can see, across various measures, valuations have risen significantly since last year and are now hovering around the high watermark from the last 2 decades. The market rally following the presidential election resulted in significant gains across major indices, including Bitcoin surpassing $86,000 and the S&P's price-to-earnings ratio now approaching dot-com bubble levels. While short-term market movements can be volatile, as demonstrated after the 2016 election, valuations are still the most reliable long-term indicator for investment returns. Markets can deviate from fundamentals such as earnings for a while, but will eventually see prices need to either adjust or earnings will need to catch up. Part of the market rally can be attributed to market enthusiasm for anticipated policy changes as a result of the election. While these short-term market movements are reflective of investor sentiment, long-term performance ultimately depends on fundamental value. Markets tend to overestimate both potential positive and negative impacts. With that said, historical data suggests that elevated valuations like we're seeing now often precede periods of lower or even negative returns, even in growth scenarios. This scatter plot shows forward price-to-earnings ratios and subsequent 1-year and 10-year annualized returns for the S&P 500. Over longer periods of time, buying at lower valuations is more likely to yield higher returns. Over the short term, however, markets can fluctuate dramatically regardless of valuations. So, while valuations do not predict timing of market rallies and pullbacks, they are highly correlated with the returns over years and decades. This is an important reason why investors should stay focused on the long term and take valuations into account when determining an asset allocation. A diversified portfolio is the best way to minimize risk while generating long-term returns. Finally, this chart shows annual total returns for different asset classes. It emphasizes the importance of diversification, as it's impossible to predict exactly which assets will outperform or underperform in a given time period. Right now, U.S. stocks are exhibiting strength, while other asset classes, including international stocks, have also generated positive returns, albeit smaller ones. While valuations are very high, economic fundamentals are strong, with steady growth in corporate earnings, strong GDP growth, and the Fed easing cycle underway. Ultimately, it's the long-term economic trends rather than short-term market movements that drive investment success in the long run, emphasizing the importance of maintaining a balanced, diversified portfolio. We hope you found this overview of the recent market rally helpful. If you have any questions, please don't hesitate to reach out. We look forward to speaking with you.